Welcome back to Talk Tickers. There's a very specific, visceral feeling you get when you are sitting at your desk.
Oh yeah, the morning panic.
Exactly. You've got your coffee in hand, you were watching the pre-market tape, and you see a ticker symbol it just falls off a cliff.
That's not a slide.
No, it is absolutely not a gentle dip. It is a violent gap down.
The classic falling knife moment.
Right, and it's that moment where you frantically check the news wires, you check the PR feed, and you ask yourself one simple question.
Did the business just evaporate or did the algorithm break?
Exactly. And if you were watching the industrial sector this morning, specifically the energy supply chain, you saw exactly that happen.
Yeah, to DNOW.
DNOW, right.
Yeah.
Or NOW Inc. for the formal crowd out there, the company that was formerly known as National Oil Well Varco's distribution arm.
A company that is honestly supposed to be incredibly boring.
Boring is the word. Reliable. The kind of stock you put in a portfolio and just forget about for 5 years.
Right. This isn't a biotech penny stock waiting for some binary FDA approval.
No.
And it isn't a crypto miner leveraging up on Bitcoin. This is a distributor of pipes, valves, fittings.
It's the plumbing.
It is the literal plumbing of the energy world. It's supposed to be about as volatile as a municipal bond.
And yet here we are looking at an absolute bloodbath. I mean, the stock opened down about 11%.
Which is bad enough to ruin your morning.
Yeah, that ruins the whole week. But the selling pressure was just relentless. It closed down roughly 19%.
Sitting right at $13.23 at the bell.
That is a massive move for a distributor. Usually these stocks move in correlation with oil prices or rig counts. A 2% move here, a 3% move there.
Right. A 20% haircut implies a fundamental break in the thesis.
Yeah.
It implies that something is structurally wrong with the company.
And usually when you see a move of that magnitude in a boring sector, it is because of a massive macro event, like oil crashing to $30 or a pandemic.
But today oil is perfectly fine. The economy is chugging along just fine.
So the culprit here was entirely internal. It was completely self-inflicted. And as a reminder for those of you joining our deep dive today, my role as the enthusiast is to find the narrative arc here, the story behind all these numbers.
And my job as the analyst is to tell you if the market is overreacting or the patient is actually in critical condition on the table.
And today we are essentially performing an autopsy on DNOW's Q4 and full year 2025 earnings call, because this was really supposed to be the victory lap, wasn't it?
It absolutely was. They just closed that massive merger with MRC Global back in November.
Right.
This was supposed to be the grand debut of the new industrial giant. The narrative going into this print for months has been the best of both worlds.
You combine DNOW and MRC Global and you get unmatched scale. You get purchasing power, you get cost synergies.
Investors were pricing this entirely based on a scale plus synergy model.
But instead of a victory lap, we got a collision.
We got a multi-car pileup. And the cause of the collision wasn't the price of oil. It wasn't a sudden lack of demand for steel pipes. It was three little letters that strike absolute terror into the heart of any COO.
ERP.
Enterprise Resource Planning.
The nervous system of the corporation.
That is the perfect analogy. And if the ERP is the nervous system, DNOW is currently having a grand mal seizure.
We're going to get into the really gritty details of why this implementation failed so spectacularly. But the headline you need to know right now is that the legacy MRC US business,
The big acquisition, right?
the whole reason for the merger, is effectively paralyzed by an Oracle system migration that has just gone completely off the rails.
And it forced them to do the one thing that institutional investors hate more than anything else.
They pulled guidance.
They pulled the guidance completely.
We will talk about the psychology of that later, but first we have to look at the scoreboard. Because if you just glanced at the top line numbers, you might actually be a little confused by the panic.
Yeah, if you didn't listen to the actual call, you might think, okay, they missed a bit. Why is everyone screaming and throwing chairs?
So let's break down the rapid fire numbers first. Give us the snapshot.
Sure. So revenue came in at $959 million. The street was looking for roughly $988 million.
Okay, so a miss of about $29 million.
Right.
In the context of a $1 billion quarter, a $29 million miss is, it's annoying.
It's a friction cost.
Yeah, it's a bad week of weather in Texas. It is not an existential disaster.
Exactly. It's roughly a 3% miss. Now, in a low-margin distribution business, missing the top line is painful.
Because the fixed costs don't change.
Right. The warehouses still cost the same to lease. So that revenue miss flows right down to the bottom line. But it's still survivable.
What about earnings?
Adjusted EPS came in at 15 cents versus a 16-cent estimate.
A literal penny miss.
A single penny. And again, if this were just about the penny miss, the stock might be down 3%, maybe 4.
Algorithms trade on the miss, but human beings sell on the narrative.
That is exactly right. A penny miss is a rounding error in the grand scheme of a billion-dollar merger.
But then you look at the GAAP number, the generally accepted accounting principles reality, a net loss of $147 million.
Yeah.
Seeing a triple-digit million-dollar loss flash red on your screen, that sets a very specific tone for the morning.
It does, but we have to be fair here. As analysts, we really need to strip away the noise for you. We need to distinguish between accounting losses and actually burning cash.
Because they aren't the same thing.
Not at all. A massive chunk of that $147 million is just merger noise.
Transaction costs, right?
Yes. The lawyers, the bankers getting paid their success fees for closing the MRC deal.
And those investment bankers do not work for free.
They certainly do not. And then there is the inventory step up.
Explain that for our listeners really quick.
It's a classic accounting quirk in M&A. When you buy a company, you are required to mark their inventory up to fair market value on your balance sheet.
Yeah.
Then, when you eventually sell that inventory, your cost of goods sold is artificially higher for that specific period.
Which kills your gross margin on paper.
Exactly. But cash-wise, you didn't actually pay that extra amount out of pocket today.
So they didn't literally light $147 million on fire in the company parking lot.
No. But it is messy, and Wall Street detests messy. However, the real metric we watch for these big industrial distributors is EBITDA.
Earnings before interest, taxes, depreciation, and amortization.
Right. Adjusted EBITDA for the quarter was $61 million. That is a 6.4% margin.
That feels incredibly thin. Don't they usually target somewhere around 8%?
High single digits is the stated goal.
Right.
8 to 9% is where they want to live. So 6.4% reflects the real friction in the machine right now.
It shows they're spending way too much money to generate that revenue.
But again, the numbers are just the symptom here. The disease is the uncertainty. The thing that triggered the massive sell-off wasn't the 6% margin. It was management getting on a call and essentially saying, we aren't going to give you guidance for the future because we honestly don't know when our computers will work again.
That is a stunning admission from a publicly traded company.
It really is.
I want to drill down on the specific language they used on the call. They said the ERP fix was a heavier lift than previously known.
A heavier lift. That is prime corporate speak for we opened the closet door and a skeleton fell on us, and then the entire closet collapsed.
Let's dive right into that skeleton. We're getting into the core analysis here, segment 1 of our deep dive, the ERP black hole. Because I think a lot of people hear ERP issues and they think, oh, the email server is down.
Or the interface is a bit clunky.
Right, or my expense report's taking a week to get approved and so 2 days. This sounds existential.
It is operational paralysis. Let's set the proper context for you. DNOW closes the MRC deal on November 6th, 2025. But specifically, the legacy MRC U.S. business, just the domestic portion, went live on a new Oracle ERP system back in August.
So in Q3, before the deal officially closed.
Correct. And usually with these massive software migrations, you have a burn-in period. You absolutely expect a few weeks of lost productivity while people learn where the new buttons are.
You model for a dip. It is the classic J-curve of implementation. Things always get a little worse before they get better.
You model for a dip, yes. But this is not a dip. This is a crater. Management described the system on the call as slow. They said it was impeding customer service. And they used the phrase, creating revenue leakage.
Revenue leakage. That sounds like literal money physically dripping out of a broken pipe, which is darkly ironic given they sell pipes.
It essentially is that.
Yeah.
If a customer calls for a specialty valve because their refinery is down and your system cannot process the quote, they do not wait.
No, they call the next guy in the phone book.
Exactly.
Yeah.
But the detail that really stood out to me, the one that actually made my jaw drop while I was listening to the call, was the processing time.
Let's hear it.
They mentioned that for some older invoices, it was taking 20 minutes to process a single transaction.
Wait, pause on that. 20 minutes for one single invoice.
One invoice. Now think about the sheer volume a distributor handles on a daily basis.
We aren't selling custom aircraft carriers here. We are selling fittings, gaskets, bolts.
Thousands of line items every single day. An average branch location might process hundreds of individual tickets.
So if your accounts payable or receivable clerk is spending a third of an hour on one line item, The math simply doesn't work.
It breaks immediately. The queue grows exponentially every single hour the office is open.
It's like that old I Love Lucy episode on the chocolate assembly line, but with million-dollar consequences.
The chocolates are coming down the belt and you just can't wrap them fast enough.
Wow.
And it ripples right into the warehouse, too. They mentioned broken workflows.
What does that mean in practice?
That means the guy in the warehouse physically cannot get a pick ticket to go pull the item. Or the system says the part is in bin A, but it's actually in bin B, and the barcode scanner won't let him override the error.
So the truck just sits at the dock?
The truck sits, the driver gets angry because he's burning time, the customer gets angry because their part is late, the sales guy is screaming at the warehouse manager, who is screaming at the IT guy, who is screaming at Oracle.
And they flat out said revenue declines sequentially in Q4 purely due to this system inability.
Yes. And there was a false dawn. This is the truly heartbreaking part for the investors who held through Q3.
What happened?
In September and October, they actually thought they had stabilized it. Revenue ticked up. They told the market we were seeing mid to high single-digit growth.
So they signaled the all clear.
They did. And then in November and December, the system just buckled again. The recovery was a complete mirage.
Why did it buckle? Did the sheer volume of Q4 just crush the servers?
It seems like it. As the order volume ramped up the system, latency issues returned with a vengeance. It just couldn't handle the load. So imagine you are Dave Cherchinsky, the CEO.
Okay.
You just bought this massive company. You are supposed to be popping champagne with the board. Instead, your shiny new acquisition is hemorrhaging revenue because the software is fundamentally broken. What is your response?
I mean, you can't just turn it off, right? You can't just flip a switch and go back to the old system once you have already migrated the data.
The bridges are entirely burned at that point. So the response is panic masked as corporate strategy. They're deploying a SWAT team.
Like a SWAT team.
But really, it is just a brute force human attack on a software problem. They have added over 200 personnel in the field.
200 new hires in a merger where the entire premise is that you're supposed to be firing duplicate staff to save money.
Exactly. And you have to understand, these are not revenue-generating hires.
Right. These aren't star salespeople bringing in new global accounts.
And they aren't engineers designing high-margin custom solutions. These are people hired to sit at plastic folding tables and manually type things into a computer.
You're kidding.
I wish I was. They are literally bypassing the new Oracle system for their big projects and manually routing them through DNOW's legacy SAP system.
So they are taking orders on paper or maybe an Excel sheet and physically typing them into the old computer system?
Effectively, yes. They're creating a massive shadow IT process just to get the business out the door.
That is just throwing expensive duct tape on a broken engine.
It is incredibly expensive duct tape. And this destroys the scale argument of the merger in the short term.
Because you don't merge for efficiency and then immediately bloat your SG&A, you're selling general and administrative expenses by hiring an absolute army of data entry clerks.
But they have to do it.
To save the customer relationship.
They have zero choice. In industrial distribution, reliability is the only currency that actually matters.
Because the product itself is essentially a commodity.
Right. A 4-inch steel valve is a 4-inch steel valve. You can buy it from DNOW, you can buy it from Ferguson, you can buy it from a local mom and pop shop down the street.
The only reason you buy from DNOW is because you trust them to get it to your job site tomorrow morning at 6 a.m.
Exactly. If you burn Exxon or Chevron on a critical part delivery, they do not forget.
They will blacklist you.
So DNOW is eating the massive labor cost to protect the long-term franchise. They are sacrificing the quarterly P&L to save the company's reputation.
Which brings us perfectly to the irony of the merger itself. This is segment 2 of our deep dive, the synergy paradox. Because this is a fascinating bit of corporate game theory that emerged from the call.
It really is. So let's look at the original pitch deck for this merger.
Oh.
We merge, we cut duplicate HR departments, we close overlapping warehouses in the same zip codes, we save $70 million over 3 years. That was the solemn promise to Wall Street.
Standard playbook, Synergy 101.
But on this call, despite the absolute disaster unfolding, they actually updated that synergy guidance.
They updated it.
They raised the year 1 cost savings target to $23 million, up from the original target of $17 million.
Okay, explain that to me. Like, I'm 5 years old. The operations are quite literally on fire. They are hiring 200 extra people just to do manual data entry, but they are somehow going to save more money than they originally thought. How does that math possibly work?
It works entirely because of the disaster. not in spite of it.
Elaborate on that.
Because the MRC Oracle system is such a total failure, DNOW has completely abandoned the idea of a slow, careful integration.
Oh.
They are fast-tracking the migration of all MRC locations directly onto DNOW's legacy SAP system.
I see. So they're killing the bad system faster out of sheer desperation.
Exactly. Originally, the plan was probably very conservative. Let MRC run on Oracle for 2 years. We'll integrate slowly to avoid disruption. We'll let the software contracts expire naturally.
Keep the boat steady.
Right. But now, the disruption is already here. The hull is already breached and the house is flooding. So they're looking at it and saying, forget it. Shut down Oracle. Move everyone to SAP right now.
So they stop paying those massive Oracle license fees sooner. They fire the external Oracle consultants sooner.
Correct. It is integration by emergency.
Wow.
The failure of the ERP is forcing them to be absolutely ruthless about standardization. So yes, the synergies actually accelerate, but it is happening under extreme duress.
It's like realizing your brand new car is a lemon, so you are forced to walk 5 miles to work every day, which greatly improves your cardio.
That is exactly what it is.
You got the health result you wanted, better cardio, but only because your car exploded in the driveway.
That is a perfect analogy. And for the investor, it is a terrifying double-edged sword. You get your cost savings on paper. That $23 million is real money. But the execution risk of a highly rushed database migration is monumental.
Migrating enterprise data is hard enough when you have 2 years of runway.
Migrating data when the house is on fire and the customers are screaming is a nightmare.
And you have to remember, they have to train all those legacy MRC employees on SAP now.
Yes.
So you have a workforce that just suffered through learning Oracle in August. They hated it. And now in February, you're telling them, just kidding, forget all that, learn SAP by Monday.
Morale has to be absolutely in the toilet.
Oh, retention risk is massive here.
Yeah.
Salespeople do not like it when they cannot sell.
No, they don't.
If the computer system prevents them from hitting their quarterly commission targets, they just leave and go to a competitor. That is a huge hidden risk we need to watch.
Let's pivot to the actual physical business of selling pipes. Because amidst all this IT drama, there's a real physical market out there they have to serve.
Right. Segment 3, growth vectors versus legacy anchors.
Because DNOW isn't just one monolithic block, it's a mix of different end markets. Let's start with the anchor, upstream energy.
This is the classic oil patch. Drilling rigs, fracking crews, West Texas, the Permian Basin.
Right. And this represents roughly 60% of the business that is not affected by the ERP issues because it runs on the legacy DNOW system natively.
So this part of the ship is floating just fine.
It is floating fine, but the market itself is very lethargic.
Why is that? Oil prices aren't crashing. WTI is holding at a very decent level.
True, but the mindset of the operator has fundamentally changed. The phrase you keep hearing across the industry, and they used it repeatedly on the call, is capital discipline.
Meaning what exactly?
The big oil majors, Exxon, Chevron, Oxy, they aren't interested in maximizing production volume anymore. The drill at all costs era is over.
They are interested in maximizing free cash flow for dividends and share buybacks.
Exactly. So they are essentially in maintenance mode.
They buy just enough replacement parts to keep the existing wells running.
Right. But they aren't launching massive new capital-intensive drilling campaigns. That means volume growth for DNOW in that segment is severely capped.
It's a cash cow.
It is a cash cow, but it is a skinny cow right now. It generates steady cash, but it does not generate any exciting growth.
So the biggest part of their business is basically in a slow decline, or at best, a plateau.
Which perfectly explains why they desperately need to find growth elsewhere. And they talked a lot about midstream and utilities on the call.
This is their safe harbor, right?
Yes. Gas utilities in particular are described as extremely sticky revenue.
Why?
Think about it. If you are a gas utility in Chicago or New York, you have 50-year-old cast iron pipes running under the city that you legally have to replace.
Right. That demand is regulatory. It's safety driven.
It doesn't care if the price of oil is at $40 or $100, the pipe has to be replaced.
And DNOW sells the high-density polyethylene pipe and the residential meters for that work.
Exactly. That was the entire strategic logic of buying MRC Global in the first place. They were incredibly strong in the gas utility space.
It perfectly balances out the wild volatility of the oil patch.
If oil crashes, the gas utility still needs to fix the leak on Main Street.
But then there was the shiny object on the call, the buzzword that every single company is trying to shoehorn into their earnings transcripts right now. Data centers.
Ah, yes. The magic words.
If you say data center 3 times into a mirror, your P/E multiple magically expands.
Management pivoted to talking about this quite a bit. They officially entered the data center market in January 2025.
What are the actual stats they gave us?
They cited 11 new customers across 4 key geographic markets.
But what are they actually selling to a data center? I mean, it's not server racks. They certainly aren't selling NVIDIA chips.
No, they are selling the industrial guts of the building.
Explain that.
Think about the physics of it. Data centers generate massive amounts of heat. They need massive heavy-duty cooling systems.
Right.
And liquid cooling is rapidly becoming the standard for these high-performance AI chips. Cooling systems need water lines, pumps, heavy-duty pipes, valves, filtration units.
Okay, that makes total sense. That is right in their wheelhouse.
And don't forget power generation. These centers absolutely cannot go offline if the grid fails. They have massive backup diesel generators or even on-site natural gas turbines.
And those huge engines need complex fuel lines, exhaust systems, specialized gaskets.
That is DNOW's world entirely.
So it is real revenue. It's not just vaporware.
It is absolutely real revenue. But we have to be critical analysts here.
Is it AI washing?
A little bit, yes.
Explain that term for the listener.
AI washing is when a company highlights a tiny, sexy part of their business related to artificial intelligence or tech just to distract investors from the boring, struggling part of their legacy business.
Look over here at the shiny object.
Exactly. 11 data center customers is great, but compared to the hundreds of millions of dollars of revenue currently at risk in the upstream and utility sectors because the computers don't work,
It's a drop in the bucket.
it's the sizzle, not the steak.
And right now, investors are deeply worried that the steak is rancid.
It's good that they are pivoting. They absolutely need to diversify away from pure oil and gas. But data centers aren't going to fill the massive revenue hole left by the ERP failure in Q1.
It's a really nice story for 2027, but it does not help us model 2026.
Not at all.
Let's talk about the actual mechanics of the financials, segment 4, the balance sheet. Because when supply chains break, inventory usually gets really weird.
Weird is a very polite way to phrase it. The inventory right now is wildly bloated. It sits at $1.192 billion.
That is a staggering amount of metal just sitting on steel shelves. $1.2 billion.
It is. Their inventory turn rates, which measures how many times a year they completely sell out their inventory, are sitting around 3x.
That is sluggish.
Very sluggish.
Sure.
For a well-run distributor, you want that turn number closer to 4 or ideally 5. And this bloat is directly tied to the ERP disaster.
Connect those dots for us. How does the software break the warehouse?
It's simple physical mechanics. If the computer cannot process the customer order, the ticket doesn't print on the warehouse floor.
Right.
If the ticket doesn't print, the truck doesn't load. If the truck doesn't load, the inventory physically sits on the rack.
And inventory that sits consumes your working capital.
Exactly.
Yeah.
You already paid the manufacturer for that valve, but you haven't been paid by the end customer yet because you haven't delivered it. It is a classic working capital trap.
So all that cash is literally trapped in the warehouse right now.
Correct. Management claims they will, quote, level their inventory as the systems finally stabilize. But right now, that is a massive drag on their free cash flow.
What about their debt profile? Did they over-leverage the company to buy MRC? Usually when you buy a massive competitor, you load up the balance sheet with debt.
Surprisingly, no. The balance sheet is actually the one fortress in this entire story.
Really?
Total gross debt is $411 million. But they have significant cash on hand, so net debt is only $247 million.
What does that put their leverage ratio at?
That puts leverage at about 1.2 times EBITDA.
That's incredibly healthy.
It's very healthy. In the world of industrial M&A, anything under 2 times leverage is considered very safe.
So they aren't going out of business.
DNOW is not going bankrupt. They have plenty of liquidity. In fact, they are actively projecting $100 million to $200 million in positive cash generation for 2026.
Okay, so to be very clear, this is an operational crisis. It is not a solvency crisis.
Exactly. They aren't going to default on their bonds. They're just going to severely annoy their equity shareholders for a few quarters.
This isn't a Chapter 11 discussion.
No, it's a Chapter 1 fix the computer discussion.
I like that. Now, there's one quick accounting note I want to touch on because it really confused some people on the retail message boards this morning. LIFO. They switched to LIFO accounting. Why?
Okay, so LIFO stands for last in, first out. It's a specific inventory accounting method. In a highly inflationary environment or a tariff-heavy environment, which DNOW subtly hinted at being worried about, The raw prices for steel and pipe constantly go up.
Okay, so the physical pipe I buy from the mill today costs me more than the exact same pipe I bought 6 months ago.
Exactly. Under LIFO accounting, when you sell a pipe to a customer, you assume for accounting purposes that the pipe you just sold was the one you most recently bought.
The expensive one.
Right, the most expensive one.
Right.
That artificially increases your cost of goods sold on your income statement.
Which mathematically lowers your reported profit for the quarter.
Right. It lowers your earnings per share. But here's the trick. Because your reported profit is lower, your actual tax bill to the IRS is lower.
Ah, so it saves actual physical cash.
It's a very prudent long-term move to preserve corporate cash flow. But it makes the quarterly earnings look much uglier on the surface. They took a $9 million non-cash charge for LIFO just this quarter.
So if you add that back, the operational numbers look a little better.
They do. It's basically a massive tax shield.
It is, and it's smart. But in a quarter where you are already missing your top and bottom line numbers, taking an elective accounting hit to earnings takes some guts.
It shows they are actually thinking long-term about cash preservation, even if the stock market brutally punished them for the optics today.
Okay, so let's summarize where we are. We have a fundamentally broken ERP system, a stagnant upstream oil market, a shiny new data center story that is very real but still way too small, and a bloated but ultimately safe balance sheet.
That is the complete picture.
Let's talk about the investor context. The stock is down 19%. Is this an overreaction by the market?
It entirely depends on your timeline as an investor. But in the short term, it is a perfectly rational reaction to uncertainty.
We keep coming back to that specific word, uncertainty.
Because investors build models. I have built these exact models. You have a massive spreadsheet with cells for Q1 revenue, Q2 EPS, full year 2026 growth.
Right.
When management explicitly says we are suspending guidance, the analyst literally cannot fill in the cells on their spreadsheet.
The formula just breaks.
The formula breaks, and when the mathematical formula breaks, the risk premium attached to the stock violently spikes.
The analyst has to assume the absolute worst-case scenario just to protect their own job.
Exactly. If you don't know if the company will make 10 cents or lose 10 cents next quarter, you have to model that they will lose 20 cents just to be safe.
So pre-earnings, what was the primary valuation thesis for this stock?
Pre-earnings, the entire thesis was synergy capture. Investors were buying the stock thinking, okay, 1 + 1 = 3. They merge, they cut redundant costs, earnings organically explode upward.
And post-earnings, what is the thesis now?
Post-earnings, the thesis is pure integration execution risk. Now, the market's equation is 1 + 1 = maybe 1 point, assuming they don't permanently break the computers.
So the valuation multiple compresses instantly.
Instantly. The stock is squarely in the penalty box.
Deep in the penalty box. Solitary confinement.
And they will stay there until they can explicitly prove that the U.S. MRC system is stable and processing orders.
What are the actual catalysts to get out of that box? What should we be watching for in the next 80 days before the next call?
3 very specific things. One is stabilization of the ERP. We need 0 more horror stories about 20-minute invoices. We need to hear the CEO say transaction times are completely back to historical norms.
Okay, that's step 1.
Step 2, a dramatic reduction of that extra emergency headcount. They need to fire those 200 temporary manual entry people to get their SG&A margins back to a healthy level.
That is the expensive duct tape finally coming off the engine.
Exactly. You absolutely cannot run a profitable distribution business with 200 extra people doing work that a computer script should do in a millisecond.
And step 3.
The reinstatement of forward guidance. Even if the guidance is mediocre or flat, just having the guidance proves that management has visibility into their own business again.
It's about restoring confidence that the pilot is actually flying the plane using the instruments and not just looking out the window hoping for the best.
It feels like a massive corporate trust exercise right now.
It is. Management lost a ton of credibility on this call. They basically admitted the IT problem was vastly bigger than they knew. Now they have to earn the street's trust back quarter by painful quarter.
All right, this brings us to the part of the show where we get a little creative with the source material. The not financial advice segment.
Standard disclaimer time for everyone listening. We are just 2 voices in your headphones analyzing public data. We are not your registered financial advisors. Do your own diligence.
If you blindly follow a trade idea and lose money, please do not blame the deep dive. This is purely an intellectual exercise for entertainment purposes.
So imagine you are a junior hedge fund analyst. You are sitting in the hot seat in front of your very angry investment committee.
Right.
The stock you covered just crashed 19% in a single session. Everyone in the room hates it. It smells like total failure. What is the pitch? How do you possibly convince the boss to buy this falling knife today?
The pitch I would make is called the broken plumbing reversion trade.
The broken plumbing reversion. I really like the sound of that. Break down the mechanics for us.
Here is the core thesis. The market has violently priced DNOW today as if the entire business model is fundamentally broken, as if longtime customers are fleeing permanently and the company is structurally imploding.
But the reality is just the software is broken.
Exactly. The physical plumbing, the heavy steel pipes, the specialized valves, the massive pumps they sell, those are all still desperately needed by the market.
Exxon, Chevron, the big gas utilities in the Northeast, they aren't going to stop buying this stuff permanently just because DNOW's website is slow.
And more importantly, you have to remember, this is effectively an oligopoly market. There are only a few really big players who can handle scale.
These massive utility customers can't just switch their entire supply chain to Amazon overnight.
They absolutely cannot. They need DNOW because DNOW has the $1 billion of physical inventory sitting ready and the highly specialized technical knowledge to spec the parts.
So the revenue is incredibly sticky, even if the customer service is currently terrible.
Right. DNOW is putting duct tape on the problem by hiring those 200 people. It is very expensive to do that, but it saves the long-term relationship.
The customer ultimately still gets their valve delivered to the rig.
The bleeding right now is purely financial. It is not structural.
So the core business stays intact beneath all the accounting noise.
The core business stays fully intact. And here is the real catalyst for the trade. Management is clearly embarrassed by this. They are aggressive.
Right.
They are essentially brute forcing the database migration to SAP. This isn't a complex biological problem like developing a brand new Alzheimer's drug where the underlying science might just fail no matter how much money you spend.
This is just a database migration. It is ones and zeros.
It will get fixed. It is purely a matter of applying enough brute force and technical labor.
It's an inevitability.
Exactly. So the financial bleeding stops simply because they force it to stop. You go long DNOW right here at these deeply depressed levels, around the $13 range.
You aren't betting on massive secular growth.
No. You aren't betting on the sexy data centers saving the world. You are strictly betting on less awful.
I genuinely love less awful trades. They are the absolute bread and butter of deep value investing.
You don't need the company to be great. You just need them to stop being terrible.
Precisely. You are targeting a very simple relief rally back to maybe $15 or $16.
Once they simply announce on the next call, hey, the invoice queue is finally clear, the uncertainty premium immediately evaporates.
And the stock pops. The 19% drop today was purely an uncertainty penalty. You remove the uncertainty, you remove the penalty.
Is there a twist to this trade? A way to really juice the returns if you're a fund manager?
If you want to get really fancy in the pitch meeting, you could pitch what I call a merger arbitrage of incompetence.
A merger arbitrage of incompetence. I absolutely love that framing. Go on.
You are essentially betting that the sheer shocking incompetence of the legacy MRC IT implementation is the exact forcing function that makes DNOW ruthlessly cut costs and integrate faster than they originally planned.
The failure forces the operational efficiency.
Right. The worse the IT system is today, the faster they panic and move everyone to the better stable system.
And the faster those massive cost synergies actually hit the bottom line.
Exactly. It is a very perverse incentive structure, but logically it works. If the Oracle system was just kind of bad, they would probably limp along for 3 years paying dual licensing fees and dragging their feet.
But because it is an absolute unmitigated disaster, they are fixing it right now, today.
And what is the risk to this trade? Because, as we know, there's always a trapdoor in value investing.
The ultimate risk is that the human duct tape fails completely. That even with 200 extra people frantically typing, they literally cannot ship the physical product out of the warehouse doors.
And the customers finally just get fed up.
Right. If a major customer signs a long-term exclusive contract with a competitor like Ferguson or Core & Main out of sheer frustration.
If they lose those massive gas utility contracts, that incredibly sticky, non-cyclical revenue we talked about earlier, the floor completely falls out from under the stock.
That is a very high-stakes poker game involving Oracle databases and warehouse scanners.
The best kind of poker game.
All right, let's wrap this deep dive up. Give us a quick recap for the listener who is just finishing their commute.
DNOW is a classic merger story currently held hostage by a completely self-inflicted IT disaster.
The financials are incredibly messy right now, showing huge GAAP losses and massive inventory bloat.
But the underlying cash flow remains surprisingly positive, and the balance sheet is very safe with extremely low leverage.
And the ultimate take-home for you.
A 19% haircut offers a really compelling, deep value look, but only if you have the cast iron stomach for turnaround stories involving messy database migrations.
It is entirely a bet on executive execution. Can Dave Sharachinsky and his management team actually fix the internal plumbing of their own company?
The broader market emphatically said no today. The contrarian says probably yes.
But it is definitely not for the faint of heart. But as always, volatility creates opportunity if you know where to look.
Keep your stop losses tight and your due diligence even tighter. Here's a final thought for you to chew on as you watch the ticker tomorrow.
What happens to the industrial supply chain if this IT paralysis isn't just an isolated DNOW problem? What if this is the canary in the coal mine for an entire sector that underinvested in tech for a decade and is now trying to modernize all at once?
Something to think about. That's it for this deep dive into the DNOW earnings call. We will be back next time analyzing another set of numbers.
Stay rational out there.
See you next time.